the key narratives from the Economic Survey 23-24, followed by a question and answer session. Over to you, sir.
Good afternoon, everybody, and thank you for being here. Just a personal declaration. We didn't organize the rain to make it difficult for you to come here. So, but we welcome it, like all of you would, given the temperature we have been facing for the last several weeks. And thank you for being here. This morning, Mint very helpfully reminded me of what I wrote in the interim economic review in January. I had spoken about global factors, the introduction of artificial intelligence, the need to balance energy security and energy transition, and of course the imperatives of employment and skilling. Now this actually picks up on those themes. And more importantly, it tries to identify the areas and actions that we need to take such that these four important challenges can be addressed as best as possible. In some sense, this survey picks up on the theme that all hands on the table must be there, and no economic approach will be exclusionary or will be excluded. We need manufacturing, we need services, we need agriculture, we need the public and private sectors to act together. We need union and state governments to act together. Because given the way the global conditions are evolving, we don't have the luxury of picking and choosing specific approaches in our path towards Viksit Bharat. And that is the overall theme of the survey itself. First, the global outlook. You can see on the charts here that both merchandise trade volume and industrial production steadily come down in terms of the averages over the last 20 years or so. Somewhere between 5 and 10%, they have come down to between 0 and 5, and now they are struggling to even stay above the 0 line. So in general, global growth and global trade volume growth will be difficult to come by. And therefore, the way we can grow our exports will not be because the trade pie is growing, but because we have to grab market share in terms of competitiveness and quality, etc. And second factor, there is global protectionism and a sense of nationalism just in time giving way to the idea of just in case. Security dominates efficiency. Supply security dominates supply efficiencies. And you can see that in the last 3-4 years, protective actions have actually moved up very, very sharply, trade protective actions. And the reasons cited are on the right side: competitiveness, climate change mitigation, national security, geopolitical compulsions, concerns, etc. But this is going to be with us for quite some time. So we need to be mindful of that. And then the climate challenge and geopolitical fragmentation. We will be speaking more about the climate. It is about balancing, as I have written also many times in the last 2 years, it's about balancing economic development and also energy transition. But let's remember, historically, energy transitions have not happened in a single generation. Václav Smil has written a lot about it, and especially with so many countries going at it together. I can have it here. especially with several countries attempting net zero at the same time and trying to achieve energy transition, it is going to be a major issue in terms of resource, etc., etc. And then when it comes to geopolitical fragmentation, we are seeing it every other day as well. And this chart on the right shows you how much the mention of geopolitical fragmentation is happening in corporate earnings releases and announcements and so on and so forth. From a bipolar to unipolar to multipolar world and different blocks emerging, etc. It is something that will be with us for some time. So these are the four headwinds that did not, for example, affect Japan, East Asia, or China when they were making their transition from lower income to higher income countries. They didn't have to face these headwinds. From 1979 to 2015, China, for example, did not have to worry so much about geopolitical fragmentation, climate challenge, and global trade. Globalization was at its peak. So we have to now chart our path to Viksit Bharat amidst these headwinds. That is why domestic growth becomes very, very important. Now we first quickly go through the state of the economy where we are, which is covered in chapter 1 of the economic survey. There is momentum in the economy. In fact, we are now 1 quarter in the new financial year, and even high frequency indicators are telling us that the economy is carrying on the momentum that we have seen until the end of March 2024, when we grew at 8.2%. So the average growth rate in the last 3 years up to March 24 has been around 8%. And as we write in the survey, real GDP is 20% above the pre-pandemic levels. And the growth has been contributed to by a steady maintenance of the share of private consumption. Capital formation is beginning to recover as we would expect post-COVID and post-balance sheet repair. And exports are doing quite well under the circumstances as well. Of course, some of you might say this adds up to more than 100, but that is to remind you of the fact that it is not subtracting imports here. So otherwise, it is not net exports, it's only exports, so it's a gross number. And investment is being driven by not only by public sector capital formation. Both union and state governments have clearly been spearheading the capital formation. But let me also tell you that private capex has been growing. Private capex has recovered after the stagnation or decline we saw in 1920 and 2021. They did pick up in 21-22 and 22-23. Of course, some of you might go into the granular details available and say that private capex formation picked up strongly in the dwellings aspect and not in the machinery and equipment and intellectual property products. But even that, post-COVID. So because if you look at the national income data, you can see the breakdown of private capital formation into these three components: dwellings, machinery and equipment, IP products, etc., intellectual property products. The recovery is beginning to come through in the latter two areas also, which is what exactly will be driving higher quality jobs. And household savings in physical assets has improved, and we have written enough about it. Households are not in distress. Households actually are investing in financial assets, which have done very well. Especially in the last 4 years, the foray of retail investors into stock markets through systematic investment plans, through mutual fund investments, has been quite prolifically documented. And our national income data do not record these at market prices. And that is the reason why there is a